Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for April 25th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and very special guest, Jeff Dickinson. Good morning, gentlemen.
Morning.
Morning.
Glad to be on your show. Thank you.
It's the first time, Jeff.
Yeah. We've been having quite a run. Dean's been busy booking us really terrific guests, and it's been good because we've gotten some really interesting perspectives, and I think people appreciate not hearing just Dean and I drone on here every single week.
Yeah, exactly.
Hey, Jeff, do you want to give folks a little short intro and background on what you've been up to in the freight industry?
Sure, absolutely, Ken. So I've been in the industry for a long time. I won't age myself, but I've seen a lot in my career, and the position that I'm in now by owning my own company and doing a few podcasts and having a good friend Dean on it as well. You know, we're in a critical part of the logistics industry right now, especially, you know, with the spot market dropping as quick as it is, looking, you know, pretty much towards 2019 numbers, which aren't too far off. And after Dean's trend analysis that he shared over the weekend, it looks grim. And it's a big concern, not just for me, but for others as well. And maybe some people that really don't understand what it all means and what that timeline of Memorial Day really means to the industry and what will happen after that. So, you know, I'm glad that, you know, I'm part of this morning and that we get to chat a little bit about the problems and, you know, looking at the what if scenario. So I appreciate it.
Awesome. So we'll bring Jeff back in towards the end. Those familiar with the show know we're going to jump into our key points of the week, and then Dean's going to walk us through our market update. So let's get to those key points of the week so we can bring Jeff back and have a great conversation. So load and equipment posts almost identical to 19 as rates continue to slide. Active contract rates for van, reefer, and flatbed continue to drop, down 1%. Replacement rates are down 9% in dry van, 8% in reefer, and 11% in flatbed. The American Trucking Association tonnage index dropped 5.4% in March, first year-over-year decrease since April of 20. If you remember what was happening in April of 20, things were no bueno. March single-family housing rebound, starts are up about 3.25%, permits up 4%. And then auction volumes on sort of 2019 levels as high mileage excess capacity is offloaded. Let's get over to Dean for our market update. Dean?
Yeah, thanks, Ken. We'll do a quick market update so we can get to Jeff's discussion towards the back end of the show. You can find the long-form version of today's market update. It'll be published this evening. Go to dat.com/market update. So let's get started with our load-to-truck ratio. Looking at load post volumes, we're up about 8% last week, continued higher by about the same amount in pre-pandemic years. So we're definitely seeing more volume on an ongoing basis. Equipment posts, though, are around 7% higher than pre-pandemic years. So a lot more capacities looking for loads. Load-to-truck ratio up slightly last week to 2.04. In the refrigerated market, load posts continue to track at around half of what they were a year ago, following last week's 7% increase. Reefer volumes, it's much slower, of course, due to produce season taking a little bit longer to get going. National produce volumes are down about 13% year over year. Some good volumes coming out of Florida, but California's down about 40% compared to the same week last year. So much slower start, and that's dragging down reefer volumes nationally in the spot market. Load-to-truck ratio up slightly to 2.80. And in flatbed, volumes increased for the second week following last week's 5% increase. Except for 2020, last week's load post volume was the lowest recorded in 7 years. In flatbed, equipment posts were flat last week, but also at the highest level in 7 years. Load-to-truck ratio at 12.56. Having a look at a couple of markets, it was noticeably obvious on the weekend when I looked at the data that the dry van capacity was tighter in the southeast where produce season is starting. There was a 3-week slide in line haul rates across the southeast. Rates were up though last week, 3 cents a mile to $1.30 for outbound regional loads. In Atlanta, southeast largest market, spot rates are up a penny per mile to $1.60. Remember, folks, these exclude fuel. So these are line haul rates excluding fuel. At $1.60 a mile in Atlanta, 4 cents a mile lower than in 2017. and 2019. High volume lanes out of Atlanta to Orlando and Miami at 227 and 195 per mile were both the lowest in the last 12 months. Having a look at the West Coast in California, outbound average spot rates at $1.81 per mile are identical to where they were in 2019. Rates in Los Angeles and Ontario markets were flat at $1.60, even though volumes were up 10%. In the refrigerated market, having a look at Florida, capacity continues to tighten naturally as produce season continues to push higher volumes into the outbound spot market. Produce volumes are up about 40% year over year when we look at the weekly volume of truckloads heading north. A lot of volume of watermelons coming out of there right now. Florida is the leading producer in the nation of that particular product. At $1.88 a mile, Florida outbound reefer rates are identical to 2018 and 2022 levels. On the high volume lane north to Atlanta at $1.61, spot rates are almost 30 cents a mile higher than the March average. The volume of reefer loads moving on this lane were up 7% in the prior month. Our Raycast forecasting tool is increasing, is forecasting rates will increase a further 66 cents a mile on this lane at a high of 227 in the first week of May. That coincides with the annual peak in outbound shipping volumes. Having a quick look at the West Coast in the large produce market in Fresno, line haul rates for outbound loads increased for the fourth week in a row to $1.69 on 4% higher volumes. And in flatbed, capacity was very tight in the Pacific Northwest, Oregon, at $2.98 per mile. We're within 20 cents a mile of record high rates reported in 2021 and 2022 last week. Solid gains were reported in Medford, the largest regional flatbed market. Volumes were up 2%. Spot rates jumped 27 cents a mile in Medford to $3 a mile average for outbound loads. A couple of the lanes that were notably higher, Medford to Denver at 203. Loads to Phoenix are up 30 cents a mile to 252. Texas, though, we've been talking about it a lot in the last 3 or 4 months. Capacity loosened last week. Rates down 4 cents a mile. That's the first time rates in Texas in flatbed have decreased in the last 3 months at $2.29 per mile. Average outbound rates are 2 cents a mile lower than this time in 2018. Wrapping up our market update with our look at year-over-year spot rates, excluding the fuel surcharge, dry van line haul rates have dropped by 18% this year, recording weekly decreases in 15 of the 16 weeks. Rates were down 2 cents a mile last week. National average was at $1.61, remains about 9 cents a mile above 2019 levels and about 5 cents a mile above the average for week 16 in the pre-pandemic years. On our top 50 lanes based on loads moved, the national average for the top 50 lanes was $1.83. That's 22 cents a mile higher than the national average. In refrigerated, line haul rates have dropped by almost 50 cents a mile this year, down 3 cents a mile last week to $1.90. It's almost identical to the average in pre-pandemic years and just 3 cents a mile higher than in 2019. And lastly, in flatbed, at a national average of $2.16, flatbed rates ended week 16 where they started at the beginning of this year. Flatbed line haul rates decreased by a penny per mile last week, almost 50 cents a mile lower than this time last year. So that's it for this week's market update. If you want to find out more about what's happening in freight, go to dat.com market update /market update and download our weekly report. It'll be published this evening. And with that, it's over to Ken for the short-term forecast.
Thank you, Dean. So as we do every week, we're going to cover our short-term forecast. By short-term, we mean 35 days. Just a level set on this chart for those less familiar. The blue line is the historical 7-day weighted moving average. We always start with dry van here. It goes back to December 1st. And that way you can get some idea of history. And then we have 4 forecast models we like to show. Again, those go out 35 days into the future. All rates exclude fuel. So we have green, which is Raycast, our flagship model. Red is a short-term model, which more heavily weights recent data and pronounced seasonality. And then you have the gray and the yellow, which are blends of the two. And what you can see is all the models pretty much clinging to any sense of normalcy and seasonality. This is going to be a theme, so I'm not going to belabor it here, but there's some really important mileage markers, if you will, coming up here in the next month or so, which will be critical for planning out the rest of your year as we continue to inch forward. I'm going to move on to reefer. There's some more alignment here in the upward direction. I would say the recent slide, I know this is a forecast slide, but I think it's a great way to show pretty much what's happened since the beginning of April, showing a very interesting, concerning, and abnormal trend. Just trying to get my adjectives in this morning. It should not be dipping at this point of the year, but it in fact is, which is obviously concerning. Let's move on to flatbed, and pretty much in alignment here. None of the models are expecting much movement. Given that the seasonal pull isn't as strong with the other equipment types, I think this makes a lot of sense. Treading water is the best way I would describe some of the economic activity indicators around flatbed, some positive, some negative, nothing too extreme in either direction. So I think from a forecast perspective, it makes sense that all of the models are in relatively tight alignment. But as I said, it's not a great picture at the current moment. So that's going to lead us to our question of the week as we bring Jeff back, which is, Dean.
Yeah, this comes, Jeff, from last week's show, I think, where you dropped a comment in the chat. We had Ryan Muhammad on, your co-host of Sales Chatter, along with Dan Deegan. And we thought it'd be a great way to start off your session this week, because one of the questions we've been asking a lot of ourselves is, when will the market find the bottom? So the question this week is, the spot market is nearing the bottom, we think. What are your thoughts on how much further we have to go before things start to improve?
Well, a lot of things have to take place. Inventory levels are still extremely high. Orders have been cut. There's no real blanket orders out there for a prolonged period of time. And the shippers are still digging deep. They have that dig deep mindset, which is like that vacuum. You pull down the spot markets, it takes that contract rate, it pulls that down as well. And it's not sustainable. We've talked about the cost of fuel, right, being at 36% right now. Totally unsustainable as far as profitability for the carriers, when they have to be below 25% to be profitable in a good market. And look at the market and the spot right now. It's falling. It's getting worse every single week. We've talked about this, Dean, over the last 7-8 weeks, and it's been consistent. And when you look at 2019 and you look at the sustainability, even though it was low, it was bouncing across the board, not too far out, right? And then you look at 2020, when you had that nice climb. Well, right now in 2023, you've got that black line that's surpassed the 2020 level. We're moving into day 118, pretty close to it. And we're still seeing that little hitch there, which tells me that, we're not going to see something that's going to drastically change in the next couple of weeks. I just don't see it. There's just not enough information out there that says otherwise, where, we see a lot of product coming in. We see a lot of product moving out. You still have, like I said, those high inventory levels. We're in trouble, and like you said, Dean, and it's a perfect data point. If we're not out of the bottom by Memorial Day, we could see the return of 2019. And we all know what that looked like, right?
Yeah, I mean, the thing I worry about is the return of 2015 heading into 16, which was an industrial-driven, profound slowdown. That one, to me, was more, right, because it didn't come off the heels of something like 18. You know what I mean? Like, I think 19 felt so slow because you were kind of used to moving so fast, the blank check year of 2018, Right. But I remember 15, 16 in industry just being so profoundly slow.
Yes.
Customer volumes not even coming close, like customers not renewing contracts because there was not volume to ship on those lanes anymore, right? I mean, that's what I remember being in the industry at that time.
Right.
The late start to produce season nationally, in particular on the West Coast, due to weather, is what's causing the concern here right now, because normally we'd start to see produce season have an impact on dry van and reefer rates around the middle of April. When I had a look at the rates from the middle of April through to July 4, going back the last 6-7 years, reefer rates go up about 26 cents a mile on average between middle of April and July 4. Dry van goes up about 21 cents a mile. So that'll partly answer Elijah Ayer's question about the upward direction. It's produce season. It's one of those seasonal forces that drags up both reefer and dry van. all the way through to July forward. Of course, it didn't happen last year because we had a really dry West Coast produce market, so volumes were suppressed. This year, we've got a much wetter start to the season, and it's delayed a lot of the crop harvesting and early season planting. So we expect the produce season will have an impact. What we don't know is when. It's certainly delayed right now as we sit here at the end of April. So we're probably 2 to 3 weeks behind where we'd normally be from a produce volume perspective when I look at how the markets typically line up. And that's part of the reason that we're not seeing any of those signals that we would normally say that we've reached bottom and the market's starting to climb back up.
Well, I do want to kind of clarify a few points. We are at bottom in terms of carrier profitability. There aren't, I mean, Jeff, you got a little more experience here, so I'm looking for your sage wisdom here, but I don't know that we can afford to shed many more nickels and dimes here and get to a level of profitability that many carriers, unless your truck's paid off and you've got a splendid insurance background and you're running a dedicated lane, you're not running very profitable at the moment. So first of all, does that check out? I don't want to presume myself.
Oh, yeah, absolutely. But where it really hurts is the shippers, because the shippers are just diving deep and they have no loyalty. And I wrote Lucky 13. I have 13 points here that I just wrote down that are impacting the spot market, and you've got on the upper right-hand side, I'm pointing over there, you got the shippers buying cheap, they're scavengers. Then you got the carriers seeking best rate loads. There's a total imbalance there. And it all comes down to negotiation practices and the long-term RFPs, if you can do that and trying to balance it out, being the good and the bad and helping the carriers get through, these issues that they're facing right now. If not, just like the shippers are, they're jumping like fleas. The carriers are jumping like fleas. They're going for the highest rate, and the shippers on the adverse side are going for the cheapest rate. And we need to tip the scale and get that to a nice little balance, because that loyalty is so important to shippers, especially if the market bounces back and we get into a nice peak season. The carriers are going to come back to the shippers and they're going to say, oh, you want us to help you? What have you done for us lately? When was the last time you asked us, hey, how can I help you? How can I help you get back to profitability? The problem is that they're only thinking of a one-way street when it should be a two-way street, and they should be traveling at the same speed, trying to help each other out. That's the biggest issue right here. Big problem.
Yeah, I think there's a couple of things. Like, what do you need to believe that the market's going to go up, right? So I think in the spot market, it's not perfect. I would not say it's a perfect commodity market. We all know that there's no such thing as true FAK. But I think it generally holds that supply and demand are the most dominant factors in spot market loads, right? So what needs to happen for the rates to start to go back up is either or. So both of these things could happen, but one of them certainly does. Either a meaningful amount of capacity needs to continue to exit, which means you'll reduce the supply relative to the demand and rates will come up, or we need to see a big influx of demand relative to the same amount of supply of trucks.
Right.
Now, I think you'd be pretty lonely. You'd be a pretty lonely economist if you were predicting a big demand tailwind heading into the summer, right? Most folks are most of the optimists out there are predicting like soft landing, near recession, but not total recession. No one I've read is predicting like gangbuster growth over the summer. So let's scratch off the demand side being the factor or the catalyst. So what needs to happen? Supply needs to reduce, which is unfortunate because that means carriers need to exit the spot market and continue to exit.
And to your point, both points, David Jackson in his earnings call from Knight Swift said this week that when the market turns, there'll be a lot less capacity, be a lot less trucks in the market, which of course, Jeff, just means that, relative supply relative demand will sort of accelerate the next market cycle, given that there is capacity that's going to leave the industry for sure.
Yeah, and I would have just kind of finished that. That's a great point, Dean. And just to kind of compound that, one of the main fallacies is that the market needs, like, once you reach bottom, you're only there for a short period of time. 19 was so bad because we stayed at bottom for a whole year.
Exactly.
So we don't have, we could just hover around. That's why we keep talking about Memorial Day coming up, because if we don't see the seasonal bump there, I would pretty much start moving my chips on the side of the table that is a lingering bottom for the most of the year, which would be, again, if you're in this industry, you have to ask yourself, if we know that capacity needs to exit, would you rather have it exit all at once and have the second half of the year be prosperous? Or would you rather have a slow burn, attriting, I don't know, 1 to 3,000 to 5,000 carriers per month out of the spot market to get to where we need to be by spring next year? And that's a big philosophical question, but one of those two things has to happen, or we get a surprise economic rebound, and all of a sudden people are buying patio furniture and barbecue grills again with the money that they don't have.
So the thing is that what's really scary, right? We saw the rebound in 2020 around day 121, 124, and it was a steady uphill climb. However, with that little hook on the 2023 data here, what happens if it crosses over that 2019 level and becomes a 2019 at a very low rate? I mean, this is all what if scenarios, That's the biggest concern that I have right now, and the huge impact that it's going to have with everybody in the industry. I'm talking brokers, shippers, carriers, anybody that's involved in supply chain. I mean, this is going to be massive. And, I don't like that hook. I really don't like that hook. And I hope that it starts climbing sooner rather than later, and that it doesn't go past the green and the mustard color 2017 and just, get below that 145 mark. I mean, we're deep.
Yeah, and I mean, I think part of the reason we had a burn our saddle 13 months ago when there was a lot of doom speak happening is because this is the time whenever we should be really concerned, right? Maybe not now. We've been talking about this for a few months now, but if we sort of mark the freight recession as starting, I don't know, a couple of months ago and really getting into the depths of it now, what we don't want is people to tune out to it, right? Right now is when you should be really, really paying attention. A year ago, you should have really been focused on making a whole bunch of money. No matter who you were, there still was tons and tons and tons and tons of money to be made. Now's the time where you need to batten down the hatches and really plan out what those next steps are going to be. Because if you're a broker, you're moving far. We were just at TIA, 2,000 of our closest brokerage friends, right?
Yeah.
They're moving far less volumes at higher margins. So that 50% of that equation gets conveniently omitted when we're talking about transparency at times, right? So right. Yes, the margins are high, but yes, so JB Hunt just released their public earnings. They went from something like 45% contract to 65% contract. They didn't do that by winning a whole bunch more contracts. They did that by attriting a bunch of spot, right? So they are moving less spot freight, which is rebalancing everything. So they're moving less volume at a higher margin. The shippers are probably consequently moving less freight and saving some money. Carriers are getting the double barrel of it here at the moment. They're moving less freight at lower revenue per mile. So the teeter-totter has unfortunately, whereas shippers were getting nailed 2 years ago, even a year ago, it's the carriers that are facing the brunt of it now. And unfortunately, General Mills has a much more robust P&L than Bob's Trucking or Jill's Trucking.
Sure.
Yeah, I looked at, just quickly while you were chatting, Ken, looked at some of the rates back to 2019. Carriers were trading at or slightly below break even for probably half of 2019. When you look at the variances in rates across the year, rates averaged $1.84 over 2019. Operating costs are about $1.63. This year, operating costs are about 21 cents a mile higher, and spot rates are about 40 cents a mile higher. When you compare 2019 to where we are today. The problem is, though, that we are heading down towards that same level of lack of financial profitability of 2019. We're not there yet, but we are very, very close. We're within, my modelling has got us within about 3 cents a mile of break even, which is, 3 cents a mile gross profit. That's after paying wages, insurance, fuel, all those sorts of things. So we're not quite at 2019 levels when you look at the average, but I think when you think about carriers that have got much higher operating costs, some of them are a breakdown away from not being able to pay their bills and being out of business. So there's a lot of variability in operating costs. There's no right answer. But when I look at the average of 2019 and where we are today, we are very, very close to a 2019 scenario. Even though diesel was down yesterday, another 4 cents, which was good news for carriers.
Yeah, that's the other thing we're not talking about. You know, an unexpected breakdown or OPEC shenanigans that drives diesel up, 20, 30 cents unexpectedly, right? So, again, there was a lot more slack in the system a year ago, right? A lot more slack. If Russia invaded Poland, God forbid, knock on wood, and diesel went back to where it was when they invaded Ukraine, we're talking. I don't want to be sensationalist. We'd be talking a meaningful exit of carrier capacity in a rather rapid fashion.
Right.
Yeah.
All right. Questions?
Yeah. I think we've answered Elijah's question about seasonality. Let me just quickly pull up my questions here. Matt Clark, if you want to send me a DM on LinkedIn, I'll get you the data you're looking for. It's actually the piece on operating costs are being published next Tuesday. I'm a week behind on that, but I want to update my numbers. So next Tuesday, we'll have that blog post out. I think question for you, Ken, from Andrew Webb. How heavily is DAT's model relying on seasonality versus macroeconomic factors?
Yeah, so it's a great question. And the answer is it really depends on where we are in the year. So in the spring, you're going to see more of an influence of seasonality, right? And the long-term trend is more impacted by macroeconomic factors. So if the economy is strong and it's driving it upwards, it's driving it up into the right trend in the model, you're still going to see a slowdown in February because there's a seasonal downpull of freight that doesn't need to move, and you're still going to see accelerated growth during what we would call like produce season leading up to the 4th of July. So the seasonality in the short term, like weather, when there's a hurricane, I don't know if this is going to translate well to my little screen, but right, you got a trend and then you got to wiggle along the trend. The wiggle along the trend is the seasonality and the short-term disruptions. The long-term trend is more guided by macroeconomic and macro freight conditions. I'll answer a question you didn't ask. Macro freight conditions play second fiddle largely to macroeconomic conditions play second fiddle to macro freight conditions, right? So if there's a big dynamic shift, like a secular shift between spot and contract, that's going to outweigh all but the strongest macroeconomic signals, right? So whether GDP is growing at 3 or 4% or industrial production is growing at 3 or 5% is going to far get outweighed if spot is going from 90-10 to 80-20, right? It's just the further you get away, and I'm presuming, by the way, you asked the question, you have background in this. The further you get away from direct data signals, the less of an impact any model like this is going to interpret. So the price of tea in China is always kind of a classic. I'm sure there's some influence in the model of that, but extremely, extremely small. Load to truck ratio, very, very high. I hope that answers the question.
Question for Jeff from Gary Bates. I think it's a volume question, Jeff. What is the smallest operation rail will work with? Example, would one 53-foot semi-trailer be moved to a small rail head?
Well, that's a great question, but I was just reading an article that cost between intermodal and over the road is about 9%. Is that worth the service level that you're going to get? Because when you put things on the rail, you're going to have an increase in transit time. That's pretty well known. So it's the sustainability as far as your supply chain and whether or not you can handle those extra days. Maybe not in this market right now because really nothing's really moving. So maybe you can. But it's something that you can definitely look into, if it's profitable. I usually use a guideline of 700 miles plus, to have an impact. Everything underneath that, I wouldn't touch with the 10-foot pole. So, hopefully that answers your question. But they'll move anything. But the thing is, you got to look at whether that move is good for you.
Yeah. All right.
So we have any more questions for you, Dean?
Yeah, there's one more. Mahalio asks, how will Reef Alliance be impacted with lower produce volumes across the country, especially the West Coast? The answer is significantly on some of those high volume lanes. There's not a lot of roads in and out of the West Coast and the Fresno market in particular. So Road Check Week coming up on the 16th is going to have a serious impact on reefer capacity on the West Coast. They have limited options to bypass the checkpoints. So you're going to take and it's not that carriers will be trying to avoid it. It's just that they're going to spend 10 to 12 hours in a massive line of trucks trying to get through on limited roads when they travel west to east. So there will be an impact on A, lower volumes, and B, road check week in particular on the West Coast coming up shortly.
Nana Tando asked about fuel costs. There's maybe if Ben can post, our marketing colleague can post. We have an article on a blog post, a sticky blog post that shows you exactly how to calculate fuel. If you're listening and don't want to click through, you just take the prevailing national diesel rate, subtract $1.25, correct, Dean?
Yep.
And then divide by 6.5 miles per gallon. That should give you the fuel surcharge. Dean, do you know offhand what it is this week nationally?
48 cents.
48 cents? Yeah, I knew he would know it. And then just a really, really, really insightful addition in our chat that I was following here by Lamb. We were talking about the broker margins, right? And he made a comment that this is only because brokers are still moving freight from previous RFPs. Once the new RFPs come into place, those margins will rectify. And I think that's just an elegant way to specifically describe one of the major mechanisms of the freight cycle, right? So that's essentially when the market starts to fundamentally turn upwards. It's when you've reached, right? So you reach a period where you have high margin, high volume, and then you have really high volume, but your margins get squeezed. And then as the rates fall, you see volume fall, but margins expand. And then that little elbow, right? If you think about it as a sine wave, right? Just like a up and down roller coaster, that little elbow at the very bottom is when volumes bottom and so do margins. And that's what necessitates the freight cycle going back up. So what Lamb illustrated is when at that very moment, when things fully rectify, contract rates will start to go up because spot rates will start to go up anew. So I thought that was really good. I wanted to call that out. That's a really astute way and an elegant way that I'll actually use, if you don't mind. Because I think it helps explain one of the major mechanisms of the freight cycle, which is spot and contract rates. You hear us say it a lot, but we probably say it very parochially. Spot and contract rates need to converge and intersect before this freight cycle can revert back to the new, the next one. And that's predominantly why. Is because until there's no savings left to be had in the spot market, contract rates will continue to drop. So, Dean, you want to wrap us up?
Yeah. I'm going to be on Sales Chatter tomorrow with Ryan Mohammed and our guest today, Jeff Dickinson. They are both co-hosts of a show called Sales Chatter with Dan Deegan, 11 a.m. Eastern. Connect with them on LinkedIn. We'll be on Landline Now tomorrow evening, 7 p.m. Eastern. Robert Rouse is the special guest. I'll be on with Jimmy Mack on Thursday morning at 8 a.m. on Radio Nemo, channel 146, Road Dog Radio. Don't forget, Freightvine is out. Special guest with Chris Kaplis is Mike Kilgore, CEO of Chainalytics. And as we mentioned a little bit earlier, don't forget Roadcheck Week is slated for the week of May 15. The focus this year is on ABS, braking, and cargo securement. Be ready for that one.
Awesome. So,
Ken, I want to answer that one question from me and Nguyen.
Yeah, please. That's exactly what I was going to. I figured it was worth the extra couple minutes to answer that one.
Yeah. So Liam, what I would do strongly is that when you're talking to these carriers, and I don't think a lot of brokers do this, is ask the carriers, "Hey, how can I help you?" I think it's a pointed question to ask, because you're going to build a business relationship with these carriers, and they're going to know that you're there to help them, that you're not just utilizing them for cheap rates, trying to move their freight for them, but they might be in a predicament. So ask them, "Hey, what geographical area you like to move in? What kind of lanes do you like to move in?" And if we happen to get those type of lanes, I'll be more than happy to reach out to you, to give you an opportunity. Always try to help the carriers, because that they're always there for you. Just make that extra effort. It really means a lot to the carriers out there.
Love it. All right. So I wanted to thank Jeff for joining us. Actually, I was referring someone over to Sales Chatter Live who had some questions specific to selling. I know you guys cover that in your weekly rotation of topics. So I sent some folks over there. How can you give just a plug on, again, where to find Sales Chatter Live and how to tune in?
Yeah, absolutely. So you can reach out and connect with Dan Deegan or Ryan Mohammed. I'm actually starting my own podcast in next month, actually, called Life Lessons and Logistics. I parted ways with Sales Chatter. I'm still going to be part of it with Dean every single Wednesday and pop my head in on Fun Day Fridays. But yeah, reach out to them. I believe in the message. They do a great job over there. If you need help in sales and want options, solutions, and alternatives, check them out. They're great. They're on every single day on LinkedIn, YouTube, Twitter. You can catch them at 11 a.m. Eastern Standard Time, Monday through Friday.
All right. We are running long here. So I just wanted to say thanks to everyone who came out to TIA. It was a really great event. The weather was awesome. Got a lot of traffic in the booth. I haven't done booth demos in years, so it was really fun actually doing some booth demos late into the night. The exhibition hall schedule is very unique at TIA, so it was fun after a long day. My dogs were barking for sure, but I wanted to thank everyone who engaged with us. It was really, really awesome. We will see everyone next week at 10 a.m. Eastern. We hope you can join us. We hope you have a great week. We hope you have a safe week, and we hope to see you next time. Bye, everyone.
Okay.
Have a great day, guys.